Hi, this is Dave Boyke and DJ Boyke here from Retirement Resources, and we just wanted to reach out to you this week and share some thoughts that as we've been doing our research, talking to our investment team, as well as talking to a lot of clients and prospects, we get questions all the time regarding what if this pandemic raises its ugly head again later in the year, or maybe it's just the market's reaction to this or some other stimulus, and there's a double dip in this market. Of course, in March, we saw a significant downturn, and then in April, a nice rebound. If nothing else, DJ, I think one of the things that should teach people, you need to allocate appropriately before these things happen, and the best time to do that is when the markets are up. That's why we're so big in sitting down with our clients each year and make sure they're properly positioned to weather the good times and the bad. Because anyone who ran to cash or sold out in March lost that tremendous recovery in April.
Yep.
And now we're in that period of volatility, and the question that I'm getting a lot is, well, are we done with this as the markets reacted now to this, and are we going to go back in a more bull pattern, or is there that danger of that a double dip?
Yeah, I think to add to Dad's point, we're talking about asset allocation. If we could encourage you to do anything, it's asset allocation, asset allocation, asset allocation. Make sure that we're positioned properly at the proper risk level for what your goals and concerns are. But as we look forward to the future is with the market, like we say, we don't know. Market timing is not something we can know for sure. But what I would encourage you to look at potentially is factors that might encourage the market to go down. Things like 25 to 30 million people being unemployed. Things like a second quarter where the market really
Gonna be bad.
We've done nothing for 3 months in
Right.
quarantine. So there's a potential when those second quarter numbers come due,
Yeah.
and we have those reported to us. That might be something that gives the market kind of a negative turn. But on the flip side, before that happens, we might also see a market rise because everybody's getting back to work, and everybody might think that's a wonderful thing. So we're facing some uncertain times ahead. And instead of you and I and all of us together trying to figure out and predict what the market's going to do on a day-to-day
Right.
basis, that's really where, going back to my opening statement about asset allocation, making sure we have the proper amount of money in either safe or very low risk accounts, and then building our pyramid from there. You've heard Dad and I talk about pyramid building as far as asset allocation is concerned for years. We've opened almost every meeting we've ever had with that asset allocation concept. And so we want to make sure that the folks that we're dealing with are properly asset allocated, which in turn is why when most people look at their statements, and we've had phone calls with people about the current market situation, most people have looked at their statements and said, hey, I know we're down a little bit, but it's not as bad as what I thought it was going to be. How come that's the case? Well, a big portion of that is because a lot of you have done the work to properly be asset allocated in advance, which the people who didn't are really getting stung a lot worse than the people who did.
Yeah, great point, DJ. And I know I hear it on almost every call that I'm making with our clients. They say things like, Dave, when you talked about having money in short-term, mid-term, and long-term positions, we kind of said, well, why do we want to keep some money in cash, and why do we want to have some money in conservative investments or safe things like fixed annuities? Why aren't we all in the stock market chasing the S&P 500? Those very same clients, DJ, what are they saying to us now? They're saying, thank you. Thank you so much for educating us on proper asset allocation. It's not just between stocks and bonds. It's between a variety of different financial products and services. And when the markets are down and you need money, you don't want to have to go and sell those stocks. You can take it out of your cash bucket or out of your annuity bucket or your conservative portfolio, and you can give that market account with the greatest upside potential a chance to weather this and bounce. Because if one thing history has told us about the market is 6 months to a year after the downturn, the most negative day, usually the market is substantially up. And so you don't want to miss that. So all of you folks that followed our advice on asset allocating and having short and midterm and long-term types of accounts, we're looking at those statements and comparing them to things that we're seeing from folks that are not our clients that are coming for a second opinion. You guys are doing fantastic compared to them. Our managers have done an excellent job. And again, we appreciate your trust and confidence.
Within the last 5 years, Dad and I talked a lot about flexible income planning, and there's no greater time to be an example of flexible income planning than the one we're currently going through right now. Flexible income planning basically is to have money, some money in guarantees, some money in risk allocated portfolios. And when the market's good and our risk allocated portfolios are doing really well, that's a wonderful time to capture some of those gains. You buy when it's low, you sell when it's high, capture those gains. But when the market's not doing well, we really shouldn't be selling off of our risk-based positions.
Correct.
We should be utilizing some of our other portfolios, which is our other more safe and guaranteed positions. And so this is the time we've been planning for. We didn't know it was going to happen in 2020, but this is what we've been planning for. So that's really what flexible income planning is all about, is using our guaranteed money when the market's not doing so well. And then when the market does get better, we can stick inside those accounts and we can ride that wave back up when it inevitably comes. We're allowed to keep that money in those positions and maybe at some point recoup those losses that we've had in March and end of February.
Yeah, well said, DJ. Again, good financial planning, folks, remember, is all about allocating that money so that you're in a position to profit, whether it's good times or unfortunately bad times like we're going through now. And we're happy to be part of that. And I also want to encourage you, you've got family, you've got friends, loved ones that need help and they don't know where to turn. And they think that all I can do is wait till this is passed and then I'll go try to find an advisor. That's not good. They want to deal with this now. If they're uncomfortable with their current investment program or their advisor and they don't really know what to do, they want to take some action now. We can do this all over the phone, over the internet. We're doing a lot of work on Zoom where we can see people face to face, and I've been taking a lot of those consultations, and it's been of great help and comfort to the people that we're talking to. So we want to just make sure that you're aware of that, not only for yourself, but for your family, friends, colleagues, people that you think that we may be able to be of help to. And be sure that any of these videos, feel free to pass them on to any family, friends, anyone that you think would benefit from these. So again, want to thank you for your time today, and we're Dave and DJ Boyke from Retirement Resources, and we're here to help you folks.